Hi, I'm Cody from Wall Street Breakdown. I didn't shave my head, so I'm going to wear this hat as we go through a follow-up video to the fundamental analysis video that we gave you a little bit earlier this week, or maybe late last week. However you read your calendar, your business, not mine. I'm going to help you through this. Now, we're not going to get super in-depth with the company, but we are going to go through what I was talking about before, where you're using a Pareto theory just to really break down the most important stuff. We're going to take a look at the company, at some of the fundamentals, at some of the fundamentals of their competitors, the way their sector works, the way their sector's working right now, what we maybe see in the future for that sector, and how that all interrelates with the way the market is behaving today, and if this might be something you might consider purchasing. But I think what we're more getting to is if this might be something you might consider doing some further research on. But this is something you're going to want to do to decide, yes, no, do I move forward with spending whatever it ends up being, the amount of time, which could be consuming amount of time over the course of months and months before you find something that you like at the price point that you like, at an entry point that you think is the right price point for the right allocation for your portfolio. Everything's got to really match up, so you're gonna have to do all this stuff. I see a lot of shadow. I swear, I didn't shave my head. See? I don't know, whatever. Forget the shadow. Okay, let's talk. Let's talk about this fundamental analysis. We are gonna look, I don't want to get too far over here in the squares. We're gonna look at Enbridge. Enbridge, what kind of company is Enbridge? This is what we talked about last time. Is the first thing you're going to want to figure out is what the hell does this company do, right? Okay, so before we get into this, when we take a look at some of these prices, hey, I'm going to do a little bit of reading, so excuse me if I end up looking at the table a little bit. It's part of the game, my friend. But first off, we're going to take a look at what the market's doing right now. The market is having a bit of a pullback, right? This is February 8th, I believe, 2018. It's just been one of those weeks since last Friday. There was a big computer sell-off on Friday. You hit a bunch of those points and things just sell. And now we've kind of been chasing our tail a little bit. This stuff happens. We were at a top that was waiting to go. PEs in every sector seem to be way blown out of proportion, way out of historical averages. What are you going to do, right? So we're going to look at this, but we're going to remember in a vacuum that this is not something necessarily, I would say, go out tomorrow, if you're watching this tomorrow, and purchase this stock right now, because we want to let this market settle down and decide just what kind of correction it might be making. But as you do your fundamentals on Enbridge or any other company, if you do see a price point that looks like the right buy-in for you, remember, you're doing your research. You might be smarter than everybody else out there. Don't undersell yourself. You might know way more than I do. You go out there, you knock it out of the park. If you think you found a right entry point, you go ahead and get that gravy train working in your direction, buddy. I'm rooting for you, right? So let's work this out. Okay. So the first thing we want to do is we want to make sure I'm going to let you follow along. We're going to see how this maybe plays out over time. Right? We're going to take a look at what we can forecast based on this and if this investment might be something we're going to want to do. Now, I'm going to get you there, but you're going to have to finish yourself off, because I'm not going to be hitting the buy button for you. Double entendre there with the last thing. And I am not going to be telling you this is the investment you should make. So let's check some boxes in regards to Enbridge. What does Enbridge do? Cody, what does Enbridge do? You're so smart. Well, okay, so oil and gas, right? There's upstream, midstream, and there's downstream. Basically, you're talking about the people that are going out, finding it in the ground, pulling it out of the ground, whatever the means is, setting up the resources to continue to pull that stuff out of the ground, natural gas, oil, whatever it happens to be, right? So then you've got pipeline companies. They're the midstream. So they're going to get you everywhere you need to go. They're going to get you to refining. They're going to get you to the shore. They're going to get you to every different junction point that you need to be going to. Obviously, your downstream is going to be your refining process. It's going to be your retail. It's going to be all that kind of good stuff. So what we're talking about in Enbridge is a company that specializes, and when I say specializes, I mean it, in midstream. They are a pipeline company. They are making sure things that are pulled out of the ground get downstream where they need to be going, and Enbridge does it phenomenally. They do it probably better than anyone else. So we're taking a look at a company that historically is fantastic. Let's take a look at exactly what they do, right? So Enbridge closed the day today at $34.34. Now, they've got a dividend of $1.92. It's $1.92, and right now it's paying out 5.45%. Now, Enbridge historically is a good dividend payer. They've had a couple of times where they've had to halt raising dividends, or, you know, like, everybody's had a little bit of a correction. We understand that. We know what we went through a decade ago. Things need to be balanced. I understand when a company has to do that. They've done that a couple of times in the past. That has happened, but historically, they do pay out earnings to their shareholders. They have one of, if not the best, dividends in the midstream sector. If you want to call it a sector, I would consider oil and gas the entire sector, but if you want to break down just midstream, if you're thinking about doing this, now, I want to say this beforehand. Before we get really into this, any company that you're thinking about, do this, do the work, do just a little bit of work and do a comparison. You don't have to be invested. You can follow things along for 6 months and just see how good you are at forecasting where things are going and how good you are at deciding where the market's going to go, where the sector's going to go, how everything is going to come together. Trust me, there's a big macro picture and a very micro picture. We're taking a look at a bit of the micro picture, most of it, but we're not going to get into the nuts and bolts of how Enbridge operates. But we're looking at the micro picture financially from the fundamental standpoint. We're looking at a macro picture inside the actual midstream companies, but we're not looking at this in a large macro sense. So if you want to do, please get into this, get into the research. Trust me, it's fun. I'm just saying, do this for any company, follow along, see how good you are at forecasting stuff. I think you'd be surprised at how good you might end up being. Anyways, Enbridge is trading at the bottom of their 52-week range right now, right around the bottom. Now we're going to find as we go through some of their competitors, that's kind of where a lot of these midstream companies sit right now. That just kind of is what it is, right? These companies are not giant growth companies. A lot of these pipelines are held up in very, very time-consuming litigation. A lot of lobbyist parties, environmentalists. There's a lot of red tape, and the red tape seems to be getting more and more in the pipeline industry, which, in Enbridge's case, who find themselves being the world's largest pipeline company with the most pipeline kilometers or miles, wherever you're from, out there in the world, and they only encompass Canada and the United States, they're in pretty good shape because those pipelines already exist. So forget environmentalists, forget lobbyists, forget any of that. Unless you have some sort of environmental issue, some sort of disastrous spill, you're not going to get too many people involved in red tape and things that are already there, things that have already been greenlit or in operation. But into the future, you will. So a company like this that already has the infrastructure in place finds themselves in a really good position. Trailing price to earnings is 23.57. You'll find as we go through the other companies, that sits right around the meat of the middle as far as the midstream companies go. Price to book, 142, so a very good price to book. If you don't know what a price to book is or price to earnings, we'll cover that in a future video. Price to book is basically just the price of the shares in relation to the amount of assets that they own, what the company actually has. We're not talking tangible book where we're actually taking out a bunch of assets that maybe aren't as tangible as we're looking at the big picture. But price to book, if you can find it around 1 or sub 1, I mean sub 1, you're getting a really good deal unless something's really screwed up. But 142 is still really, really good. Right around averages though. It's not anything we're not blowing it out of the water as far as midstream pipeline companies go. That's a pretty good price to book though. Cash to debt ratio is 0.01. Not holding a lot of cash in regards to the amount of debt they have, but historically, they are actually quite a bit better. They actually are quite a bit better. I mean, when you look into the numbers, they just historically have a lot more cash on hand in relation to their debt. But Enbridge does, again, like I said, have a habit of putting out a lot of their earnings per share back into their dividend. We've seen a dividend increase very recently that's going to come into effect on the 14th of February. That was over 10% dividend increase. Very, very significant. They like giving the earnings per share back to the shareholders. That could be one of the reasons why you see a lot of midstream companies not roaring when the stock market roars and not finding themselves as favorable in an up market, right? They're predictable. It's a little bit boring. It doesn't have a lot of growth involved. You know, they're a cigarette company or a utility. People understand what they're doing. They can forecast for a long period of time. It's just not a company that's going to run when the market runs. The market runs on growth. We need a little bit of volatility, but these are the companies, big dividend payers, steady companies that have their infrastructure in place, that have their debt well in order, regardless of their cash to debt ratio. You know, Enbridge is a well-oiled machine, no pun intended again. They're doing a really good job. So when the market gets some volatility back, these start to become the much safer option, and share prices tend, now I'm not saying we're going to find that happening, but do tend to go up again, trading right around the bottom of their 52-week range. Debt to equity is 1.14, very good debt to equity ratio. They have a lot of equity. There's just no two ways around that. Enbridge owns a lot of stuff, right? So regardless of the amount of debt that's out there, their debt rating is fine. Moody's, S&P, there's no issues regardless cash or debt. There's just no issues with Enbridge when you take a look at any of the numbers. But like we said, largest infrastructure in the world as far as pipeline goes. And you got to think, okay, so oil's up. This is another thing I want to get to just to make sure everybody understands the way that midstream works. Oil is up, right? Oil's up, what, $65 a barrel, something like that. Trading in that range right now, February 8th, 2018. It's not hinged on the oil price. So let's not pretend that they're related to like ExxonMobil or something, or BP or Royal Dutch Shell or Chevron or any of these other companies. They have nothing to do with that. They're more like a toll collector. They get the money for moving things from point A to point B. So you're going to look at them, they're going to be way more concerned with things like volume, capacity, how much of that pipeline is full all the time. They're able to ship stuff, and these guys have connections everywhere. They are connected to every major junction point, every major shoreline across North America. They are everywhere that they need to be. They are heavily invested in the Bakken Shale. They're in the Eagle Ford Shale. They're in the Permian Basin. They're in the oil sands in Alberta, where I am. They are everywhere where the fracking and the oil is being pulled out of the ground in every different condition that oil comes out of the ground, whether it's fracking or oil sands. They are there, and they are there en masse. So you do not have to worry about this company being a poor investment. If you find the right entry point, we know historically, regardless of where stock markets are today and where this is today, this price, 34 at the bottom of the 52-week range, regardless of that, historically, markets trade up. And best of breed companies move with markets, regardless of if they pay back out in share price increases. And don't get it twisted. It doesn't make a difference if the share price doesn't go up significantly. There are a lot of blue chip companies that do not have significant share price growth in bull markets. They have decent share price growth in bull markets, but they pay back significant amounts of earnings in dividends, which is a very reassuring way to know that you're going to be making income off this investment. And if you think you get it somewhere around the bottom, you're probably going to find yourself in a fairly good way. And these companies, because Enbridge is trading not only near the bottom of the 52-week range, but I mean, they're trading in a range they haven't traded in, or they've touched down in this a couple times in like 7 or 8 years. I mean, it is a bottom, I would say, for midstream, regardless of the bull market that we've gone through the last couple of years. So again, we talked about the legislation. That is something that you don't need to worry as much about as you do with like a Kinder Morgan, that are dealing with tons of legislation issues. And again, please, there's tons of legislation, there's tons of litigation. Go into the news, get deeper into Enbridge. Don't be making investment decisions off of us just going through some bullet points, but these bullet points are the starting point of where you're going to say, this is worth pursuing further. This is something I'm going to keep an eye on. I'm going to invest my time in. I'm going to get more in depth and make sure that I know Enbridge like I know the back of my head. Whoa, didn't see that there before. Strange. I'm going to have to look at the back of my hand more frequently. You just keep looking at Enbridge. So everywhere, they're everywhere. They're covering everything they need to do They're a toll collector. They're not hinged to the oil price. The big thing about this, before I get into the comparison between other companies, and I think Enbridge is a great company. When I say it's a buy right now, I think comparable to some of the other midstream companies, it's right borderline if I was picking a midstream company. But again, I want this market to settle down, but I really do like Enbridge. And in fact, as I've gone through this, I'm making sure that I'm keeping an eye on Enbridge and another company that's in this. But what I want to say is, United States, Canada, in this period of time, 2018, we have reached kind of that crescendo where we are now not only oil independent, but we are exporters, no longer importers. All these pipelines are set up. Enbridge has all these pipelines. These pipelines are going everywhere. And as we become an exporter in a world where petroleum and natural gas are not going away, I know there's been tons of discussion for alternative fuels for years and years. That just hasn't panned out. Well, it hasn't panned out en masse. Still, this is what is being used. Petroleum, especially. When you become an exporter in a country that's going to be probably the biggest or one of the biggest producers in the world, in a world that needs petroleum, and you hold pipelines in all the integral areas, I mean, honestly, who's going to make money going forward? I mean, just saying, right? I mean, all you got to do is put the pieces together to understand that this is not going to be a failing company. Even a major catastrophe, disaster sort of issue would not take this company to its knees. It would hurt it in the media. It would hurt it in all the fines and legislation it would end up having to deal with. But honestly, if you are looking for a solid company, Enbridge and some of the constituents in the midstreams are very, very solid companies. Enbridge maybe stands out amongst the best. Again, U.S. becoming a major oil exporter, and you can only imagine that's going to get more and more severe as time goes on. Who's going to benefit? People that got the pipelines built already that don't have to worry about the legislation. Enbridge. So some of their competitors, let's take a look at it. So Enterprise Products Partners, $26 a share right now, 6.38% dividend. So a little bit higher than Enbridge's dividend. Makes me think, Enterprise, what else are you doing? 52-week range, they're trading in the middle of the 52-week range, which is kind of an albatross as far as the midstreams go as of right now, because everybody else is trading at the bottom, except for Enterprise. Price to earnings, 20.51, trailing price to earnings. I'm liking the look at Enterprise too, just saying, but we get to the price to book, 2.51. When we're talking about Enbridge, we're talking about a price to book of 142,251 is a lot more expensive. Just putting it out there, right? Debt's in good shape. The debt to equity ratio, 1.11. Enterprise Partners definitely makes you think, okay, now I'm going to take a look at Enbridge, but I'm also going to take a look at Enterprise. I'm not going to assume that either one of these companies is better. And you could find multiple companies in a sector that are really good companies that are both solid investments. It's just a matter of what you think is going to be the best investment for you going forward. You've got to get down to the nuts and bolts of things and why you think one will be the winner over the other, or what you like one is doing over the other. That's why breaking these down is very, very vital. But if we're being honest, Enbridge and Enterprise both looking fairly good. Kinder Morgan, $16.80 with a dividend of 2.89%. They're trading near the bottom of the 52-week range as well. Price to earnings of 17.29, not bad for a trailing price to earnings. Price to book of 1.07 and debt 1.09. If that dividend was a little bit higher, I mean, because you're at the bottom of the range, don't tell me that Kinder Morgan is going to have a run higher than Enbridge is going to have a run. When everybody's in this range and this sector starts to move, I don't think you're going to have large breakouts from one company unless it's on news. If it's going to be a breakout because the sector starts to move, everybody's going to move with it. When you look at Kinder Morgan, if I'm sitting on it right now, let's say I'm sitting on it at 34.34. Let's say I buy it and it sits here for a year, or it putzes around in this range. I want the bigger dividend, right? So all of a sudden, Enterprise and Enbridge, they just look better than Kinder Morgan, even though Kinder Morgan, the rest of their numbers, if we were talking about a sector that was on the move, Kinder Morgan still looks pretty healthy, but they're going to need some growth to make up those percentage points you're missing on that dividend. Williams, 28.56, 4% dividend. They're trading near the bottom of the 52-week range, a price to earnings trailing again. So look into a forward price to earnings, trailing price to earnings. If they're out of whack sometimes, it could be because some specific charge the company took. There could be all sorts of reasons, right? So just take a look into it. 52.63, very high trailing price to earnings. Price to book, 2.91. That number in and of itself scares me off when you consider the dividend's not near where it could be. Price to book 2.91. I'm not really into this. Debt 2.60. When debt to equity ratio. Okay, so sorry, Williams, big natural gas pipeline company. It's just not happening. You've knocked yourself out of the running with Kinder Morgan sitting in third. With I would say Enbridge still probably at the top, but Enterprise very, very close. A 1B in this comparison. TransCanada 42.04, no dividend, no dividend. You better be getting me some growth. Bottom of the 52-week low, bottom and no dividend. TransCanada. There's nothing TransCanada is going to do that's going to blow things out of the water that you can imagine. TransCanada is going to jump significant share price with a company like Enbridge and a company like Enterprise Products Partners sitting on the sidelines and having no growth unless it's on tremendous news. And I don't know of any TransCanada news that's supposed to be coming out. Not anything that we're waiting on with bated breath that should drive this up well off of the bottom 52-week that it's on, right? So we'll take a look at the rest of it. Price to earnings 28.13, little high trailing. Again, take a look at the forward. Price to book 2.25 with debt 1.78, debt to equity. Kind of out of the running, right? Sitting there in that fourth spot along with Williams. Kinder not bad, nothing I would consider looking into at the moment. I wouldn't go super in depth with it. When you consider allocating for your portfolio, the diversification opportunities that you have with the oil and gas industry, the upstream, midstream, and downstream, this is only one small part of it. These guys are very specialized, but they are one small part of it, but there are not a lot of them. They definitely have a nice little corner on this marketplace. They're not very worried about a whole lot of people popping up and all of a sudden encroaching on their business. It's basically them competing with themselves, and they're not going anywhere. Like we said, volume and capacity is going to pick up as we start exporting even more off North America out to the rest of the world. Enterprise and Enbridge, I think they're both pretty good. I think both these numbers stand out. I would do research further on both of them. This is a bit of a fundamental breakdown. This is just a good way of taking a look at how companies are doing, take a look at comparison of the sector, where you see things going in the future as far as the industry goes. You just really got to do the work. You got to do the work, and you got to use as much insight as you possibly can, and you got to find a good entry point. You know, you want to make sure that you feel comfortable with where you're buying something. Don't rush yourself. This is a long game. This is the long con. This isn't short money. We're not worried about really quick stuff that happens, you know, in a short period of time, short window of time, a short time frame, however you want to frame that phrase. It doesn't matter to me. The fact is we want to get into good, strong companies we feel comfortable with owning. Then we don't have to worry about making an intraday flash trade to get out of something as things pull back a little bit, like we've seen in the last couple of days. If you were in stuff that you thought weren't just racing way farther than they should, you probably would have been fine the last couple of days. There's companies that have been up just because the Dow's down. There's companies that are up. Not these companies specifically, but like we said, midstream has been getting beat down. Everybody except for Enterprise trading at the bottom of the 52-week range. That turns around at some point in time, and these dividends with a couple of these companies are excellent. Infrastructure, excellent. Future looks excellent. Just saying, a little further research might be needed. There might be a couple investments I might be making in my future. I'm Cody from Wall Street Breakdown. This was a quick fundamentals breakdown of Enbridge, ticker symbol ENB for those playing at home. Shout out to Jim Cramer for the home game reference. Cody from Wall Street Breakdown. If you haven't already, like, subscribe, comment, do all that jazz, and go out there and invest and shave your damn head before you get on camera. Yeah! Have yourself an outstanding rest of the day.